Imagine this. You're sitting at home, checking your bank account, feeling secure in the system that's supposed to protect your hard-earned money. But what if I told you that one massive event shattered that illusion forever? Exposing secrets the banks have buried deep to keep you in the dark. Secrets that could have saved millions from ruin, but instead lined the pockets of the elite, while everyday people like you and me paid the price. Today, we're diving into the crisis that changed money forever, what banks never told you. Stick around, because by the end, you'll see the world of finance in a whole new light, and you'll never trust your bank the same way again. Let's rewind to the early 2000s. The economy was booming. Houses were flying off the market, stock prices were soaring, and everyone seemed to be getting richer. But beneath that shiny surface, something sinister was brewing. Banks, those pillars of stability we rely on, were playing a dangerous game. They were handing out loans, like candy at a parade, loans, to people who couldn't afford them. Subprime mortgages, they called them. Sounds technical, right? But here's the hook. What if these weren't just bad business decisions? What if they were part of a deliberate strategy to inflate profits, knowing full well the bubble would burst? And burst it did, in 2008, triggering the worst financial crisis since the Great Depression. But the real question is, why didn't the banks warn us? Why did they keep these risks hidden, letting families lose their homes while executives walked away with golden parachutes? Picture this emotional roller coaster. A young family, let's call them the Johnsons, saves every penny for their dream home. They get approved for a mortgage they can barely afford, thanks to teaser rates that banks pushed aggressively. Don't worry, the loan officer says with a smile. Property values only go up. But that's the first secret. Banks never told you those adjustable rate mortgages were designed to reset higher, trapping borrowers in payments they couldn't make. As interest rates climbed, the Johnsons watched helplessly as their monthly bill doubled. Foreclosure notices piled up, tears flowed in the kitchen late at night, and soon, they were out on the street. Multiply that by millions, and you have the human cost of the crisis. It's not just numbers on a screen. It's shattered dreams, broken families, and a generation scarred by financial trauma. Doesn't that make you wonder, what else are banks hiding right now that could upend your life tomorrow? As the housing market overheated, banks bundled these risky loans into complex financial products called mortgage-backed securities. They sold them to investors worldwide, promising steady returns. But here's where the curiosity peaks. Did you know these securities were rated AA, supposedly as safe as government bonds, by credit agencies that were paid by the banks themselves? Conflict of interest much. This was secret number 2. The ratings game was rigged. Banks knew the underlying loans were junk, but they paid for glowing reviews to offload the risk. When homeowners started defaulting en masse, those safe investments turned toxic overnight. Pension funds, schools, and even entire countries like Iceland got burned. Imagine your retirement savings vanishing because banks prioritized short-term gains over long-term stability. It's heartbreaking, isn't it? The trust we place in these institutions, only to find out they were gambling with our futures. But wait, it gets even more intriguing. As the crisis unfolded in 2007 and 2008, Wall Street titans like Lehman Brothers collapsed, sending shockwaves through the global economy. Stock markets plummeted, unemployment skyrocketed to 10%, and trillions in wealth evaporated. Yet, amid the chaos, banks had a lifeline. They never disclosed to the public their cozy relationship with the Federal Reserve and government bailouts. Secret number 3. While Main Street suffered, banks received over $700 billion in taxpayer-funded rescues through the Troubled Asset Relief Program, TARP. But here's the twist that keeps you hooked. Many banks were as troubled as they claimed. They used bailout money for bonuses, mergers, and even dividends to shareholders. Remember AIG? They got $182 billion in aid, then paid out $165 million in executive bonuses. Outrageous, right? The emotional sting comes when you realize your tax dollars propped up the very system that failed you. All while banks whispered sweet nothings to regulators behind closed doors. Now, let's pull back the curtain further. What changed money forever wasn't just the crash at S. How banks manipulated the narrative to avoid real accountability. Post-crisis, we got the Dodd-Frank Act, promising stricter oversight. But secret number 4. Banks lobbied fiercely to water it down, ensuring loopholes remained. They never told you about too big to fail, a concept that allows massive institutions like J.P. Morgan Chase or Bank of America to take outsized risks, knowing the government will step in if things go south. This moral hazard breeds recklessness. Think about it. If you knew someone would always bail you out, wouldn't you push the limits? That's exactly what banks do, and it's why smaller crises keep bubbling up, like the 2023 regional bank failures. The curiosity builds. Are we on the brink of another one? With inflation rising and interest rates fluctuating, what secrets are banks hiding today that could trigger the next meltdown? Let's dive deeper into the emotional core. Remember the Occupy Wall Street movement? People camped out in parks, chanting banks got bailed out, we got sold out. That raw anger stemmed from the hidden truth that the crisis widened the wealth gap like never before. The top 1% recovered quickly, their portfolios buoyed by cheap money from the Fed's quantitative easing. But for the average Joe, years of stagnant wages, underwater mortgages, and credit scores in the toilet, it's gut-wrenching to think about the suicides linked to financial despair, the families torn apart by debt. Banks never told you that their predatory lending targeted vulnerable communities, minorities, low-income earners, exacerbating inequality. Studies show African American and Latino households lost over half their wealth in the crisis. How does that sit with you? The system isn't just broken. It's designed to keep certain people down while others thrive in secrecy. But here's where the story turns hopeful, yet still laced with curiosity. The crisis birthed innovations that challenged the old guard. Enter cryptocurrencies, like Bitcoin, born in 2009 as a direct response to banking failures. Satoshi Nakamoto's white paper famously referenced the Times headline about bank bailouts, signaling a new era of decentralized money. Banks dismissed it at first, but now they're scrambling to catch up with their own digital assets. Secret number 5. Banks are quietly investing billions in blockchain tech, knowing it could disrupt their monopoly. But they won't tell you how fiat money, your dollars, is infinitely printable, leading to inflation that erodes your savings. Crypto promises scarcity and transparency, but is it the savior or just another bubble? The emotional pull is real. Imagine regaining control over your finances, free from bank fees and hidden charges. Yet, the volatility keeps you on edge, wondering if history will repeat itself. As we unpack more, consider the shadow banking system, a web of non-bank entities like hedge funds and money market funds that operate with even less oversight. During the crisis, this shadow world amplified the damage, with runs on money markets freezing credit. Banks never told you about their off-balance sheet vehicles, like special purpose entities, where they hid trillions in risky assets. Enron-style accounting tricks, but on steroids. The curiosity hooks you. How much is still hidden today? With derivatives, markets ballooning to over $600 trillion, 10 times global GDP, one wrong move could dwarf 2008. It's terrifying yet fascinating, like peeking behind a forbidden door. Emotionally, it evokes fear for your children's future, but also empowerment through knowledge. Let's humanize this further. Meet Sarah, a single mom who worked 2 jobs to buy her first home in 2006. The bank assured her it was a smart investment. Fast forward to 2009, she's laid off, her home value halved, and the bank forecloses without mercy. Stories like Sarah's are legion, fueling a distrust that's lingered for nearly 2 decades. Banks, secret number 6. They profited from foreclosures, buying back properties at auction for pennies on the dollar, then reselling at a markup. It's a cycle of exploitation that preys on desperation. Doesn't that ignite a fire in your belly? The emotional curiosity drives you to ask why. Do we keep banking with them? Alternatives like credit unions or fintech apps offer transparency, but habit and fear keep us chained. Now, fast forward to today. The crisis changed money by ushering in an era of ultra-low interest rates, ballooning national debts, and central bank dominance. The Fed's balance sheet exploded from $800 billion pre-crisis to over $9 trillion now. Secret number 7, quantitative easing, or printing money, disproportionately benefits asset owners, the rich, while inflating everyday costs for the rest of us. Banks borrow cheap from the Fed, lend at higher rates, and pocket the difference. It's a hidden tax on savers. With global debt at $300 trillion, the next crisis looms. Will it be triggered by commercial real estate woes, like empty offices post-pandemic, or geopolitical tensions disrupting supply chains? The suspense is palpable, keeping you glued as we explore. But knowledge is power. Post-2008, savvy individuals diversified, investing in gold, stocks, or real estate to hedge against bank failures. Banks won't tell you about the power of financial literacy because educated customers demand better. Imagine the freedom of building an emergency fund that covers 6 months' expenses, shielding you from the next downturn. It's emotionally liberating, turning fear into confidence. Yet, the curiosity lingers. What if banks are engineering the next boom-bust cycle right now? With AI-driven trading and high-frequency algorithms that flash-crash markets in seconds. Delving into the psychological toll, the crisis spiked anxiety and depression rates. People lost not just money, but faith in the American dream. Banks, secret number 8, their marketing portrays them as community pillars. But internal memos reveal profit maximization above all. Leaked documents from the era show executives joking about neutron loans killing the borrower, but leaving the house standing. Chilling, right? This betrayal fuels ongoing skepticism, pushing more towards peer-to-peer lending or decentralized finance. Deep dive. The emotional arc here is from victimhood to vigilance. Don't let history repeat. As we near the end, reflect on how the crisis reshaped global finance. Europe faced its own sovereign debt crisis, with banks exposed to Greek bonds. Asia learned to build forex reserves. But universally, trust eroded. Secret number 9. Banks now use big data to profile you, deciding loans based on your online behavior. They track everything: your social media, shopping habits, without full disclosure. Invasive? Absolutely. It raises questions. In this surveillance economy, is privacy the next casualty? Finally, the ultimate revelation. Secret number 10. The crisis proved money isn't just paper. It's a social construct built on confidence. When that crumbles, everything changes. Banks never told you because admitting fragility threatens their empire. But now you know. Armed with this, you can protect yourself, diversify, educate, and question everything. If this opened your eyes to the hidden world of finance, hit that subscribe button now for more eye-opening truths that could save your wallet. And for the next video, visit the channel.